Right now, as we watch the market's pulse on this Friday, December 5, 2025, Nvidia stock is trading at exactly $182.43, down approximately 1% for the intraday session. To the casual observer glancing at a ticker tape or checking their Robinhood app, this red figure might look like a sign of exhaustion, a crack in the armor of the world's most significant company. The expectation right now, the narrative dominating the headlines and the chat rooms, is that the AI supercycle is finally hitting a wall. People see the cooling price action today and assume demand is tapering off, or that the recent rumors about the Blackwell chip overheating are causing genuine structural damage to the company's order book. That is the expectation. A natural pullback after a historic run. A moment where gravity finally asserts dominance over a stock that has defied it for 3 years. But the reality is far more complex and, frankly, far more interesting. What we are witnessing isn't a slowdown in demand. It is a fundamental shift in who is buying and why. The selling pressure you see on the screen today is not a result of customers walking away. It is a rotation, a sophisticated reshuffling of positions by institutional giants who understand that Nvidia is transitioning from a hardware vendor into something the market has not quite priced in yet, a utility provider for sovereign intelligence. When you look at the price of $182.43, do not see it as a price tag for a share of a chip company. See it as the current entry fee for the infrastructure that will define the next decade of global economics. The gap between that expectation of a tech bubble popping and the reality of a sovereign utility emerging is where the profit potential lives for those paying attention. To understand why this seemingly minor 1% drop is actually a bear trap, we have to look closely at the intraday mechanics we are seeing right now. Volume is heavy, sitting at over 700,000 shares traded just in this snippet of the afternoon, which tells us that hands are exchanging rapidly. This is not a low-volume drift lower. This is a battle. On one side, you have retail traders and nervous momentum chasers exiting positions because they are terrified of the Blackwell overheating headlines that circulated recently. On the other side, you have automated purchasing algorithms and massive funds. Think of the flows you might see through Fidelity Investments or Schwab Intelligent Portfolios, quietly absorbing that liquidity. The market is currently digesting the transition from the training phase of AI, where companies bought chips to build models, to the inference phase, where companies buy chips to run those models. The market expectation was that once the training clusters were built, sales would drop. The reality, which we are seeing in the supply chain data today, is that inference requires exponentially more compute than training over the long run. Every time you ask a question to a chatbot, every time a Tesla stockholder uses full self-driving, and every time an automated agent books a flight, that is inference. Nvidia is not just selling the shovels anymore, they are selling the ground the shovels dig into. This disconnect is why the stock is pinned here in the low 180s instead of soaring to 200 or crashing to 150. We are in a consolidation zone that usually precedes a violent move, and the direction of that move depends entirely on whether you believe the overheating story or the inference story. Let's tackle the elephant in the room that is weighing on the price right now, the Blackwell architecture. For weeks, the airwaves have been filled with reports about thermal issues in the server racks, causing delays for major clients like Microsoft and Meta. The expectation from the street was that this would lead to a disastrous earnings miss or a lowered guidance. However, reality struck differently during the Q3 earnings report released in late November. Nvidia didn't just meet expectations, they crushed them, with $57 billion in revenue, up 62% year over year. The data center revenue alone, $51 billion, is a figure that is almost difficult to comprehend. To put that in perspective, that single quarter of data center revenue is larger than the entire market capitalization of many companies listed on the S&P 500. Yet, the stock is down today. Why? Because the market is forward-looking. The market is no longer impressed by 57 billion. The market wants to know if the Blackwell delays will cause a vacuum in Q1 2026. This is where the tension lies. The bears argue that if Microsoft can't get the chips they need now, they might turn to AMD or internal solutions. But here's the counter-narrative that justifies holding through this volatility. The delay is not a demand problem. It is a physics problem that only Nvidia can solve. The overheating isn't a flaw. It is a side effect of pushing silicon to the absolute limit of what is physically possible. By solving this, Nvidia deepens its moat. When you invest online or manage your own individual brokerage account, it's easy to get spooked by technical glitches. But for a hyperscaler spending $10 billion, a 2-month delay to get a working B200 chip is irrelevant compared to the risk of buying an inferior product from a competitor. Speaking of competitors, we can't ignore the noise coming out of China. Just recently, China's Nvidia, a company called More Threads, saw its shares surge 500% in its Shanghai debut. This has rattled some investors who fear that geopolitical tension will lock Nvidia out of the massive Chinese market forever, or that a domestic champion will rise to steal market share. This is a classic headlines-driving fear that reality does not support. While More Threads is an impressive story, the reality is that they're competing for the low to mid-end market. They're not competing for the cutting-edge sovereign AI clusters that define Nvidia's valuation. The U.S. government restrictions are indeed a hurdle, but they have also inadvertently created a scarcity premium for Nvidia's products on the gray market. And they have forced Nvidia to innovate faster to stay ahead of regulatory curves. When you look at the landscape of investment, whether you're using SoFi Invest for your active trading or checking your Fidelity IRAs for long-term holds, you have to separate news from material impact. A competitor rising in Shanghai does not negate the fact that the entire Western world's digital infrastructure is being rebuilt on CUDA. The ecosystem lock-in is stronger than the hardware specs. It's similar to the Apple stock phenomenon. People don't just buy the iPhone because it has the best camera. They buy it because they're locked into iMessage and the App Store. Nvidia has done the exact same thing with enterprise AI. Developers learn CUDA in school. They build on CUDA. Switching to AMD's ROCm or a Chinese alternative is not just a hardware swap, it's a rewrite of the entire software stack. That is a switching cost that most CFOs are not willing to pay. Now let's zoom out and look at the broader macroeconomic picture affecting the stock today. We are in December 2025. The Federal Reserve is navigating a delicate path with interest rates, and the Santa Claus rally is currently in jeopardy due to persistent inflation fears and volatility in the tech sector. High interest rates generally hurt growth stocks because they increase the cost of borrowing for the companies that buy Nvidia chips. If rates stay high, can startups afford to buy H100 or Blackwell clusters? That is the fear. But the reality is that AI capital expenditure has decoupled from traditional interest rate logic. Big tech companies, Microsoft, Google, Meta, Amazon, are sitting on cash piles that rival the GDP of small nations. They don't need to borrow money to buy Nvidia chips. They are engaged in an existential arms race. If Google stops buying chips, Microsoft wins search. If Meta stops buying chips, TikTok or a new AI social platform wins engagement. They have to spend. This creates a floor for Nvidia's revenue that is independent of what the Fed does next week. It is a unique situation in financial history where the largest customer base is price insensitive because the alternative to spending is irrelevance. This is why you see Fidelity wealth management funds and other major institutional players maintaining heavy overweight ratings on Nvda despite the high valuation. They know the spending is mandatory, not discretionary. Let's take a brief moment to engage with what's happening in your own portfolio. I want to know where you stand on this. Comment below how many shares of Nvidia you currently hold, or if you are waiting for a dip to $175 to enter. Also, are you hedging your position with any competitor stocks like AMD, or are you all in on the green team? It's always fascinating to see how the sentiment in the comments aligns with the institutional flows we track. Moving back to the analysis, we need to discuss the sovereign AI thesis, which is the next major catalyst that the market is currently underestimating. Jensen Huang has been vocal about this, but Wall Street is still treating it like a buzzword rather than a business line. Nations, Japan, Canada, France, India, Saudi Arabia, are realizing that they can't rely on American tech giants to hold their cultural and linguistic data. They want their own AI. They want to train models on their own history, their own laws, and their own languages inside their own borders. This requires building national data centers, sovereign clouds. Who is the only partner capable of delivering